All right, we will get rolling. Thanks again for everybody who has joined. This is the 2023 Market and Economic Recap. I'm Evan Barnes, founder and chief investment officer here at Traction Financial Partners. Joining me is Drew Barnes, director of financial planning here at Traction, and we will be walking through primarily a recap of 2023 and the market and the economic outlook that we also see going forward, but mostly recapping last year and kind of how we got to where we are today. So what we'll do here, let me jump to the next page. Actually, before I do that, if you have questions along the way, we're going to take questions at the end in terms of going over them. But if you have questions, throw them into the chat. Okay, so at the top of your screen, you should see the chat button, and we can answer those questions at the end. But we will go ahead and get going here. Today's agenda, we're going to recap the 2023 year-to-date cap or the equity markets, look at the returns, a couple of the slides in here that I think that will be pretty interesting, looking at the S&P 500 intra-year declines. Every year we see a decline at some point in the S&P 500, that versus how the year ends at the end of the year in terms of returns. You can look at the S&P 500 index, its concentration. Last year we saw for most of the year the market being driven by just a handful of stocks. How did that transpire into the fourth quarter? We'll go through that. Look at the different style box and asset class returns. Something that we'll go over, as well as growth stocks versus value stocks in different interest rate environments. And we'll make sure to touch on interest rates and what the market and the Fed is expecting on the interest rate front this year. Talk about commodity returns, as I just mentioned, get into fixed income, key interest rates, what the Fed's expecting to do. We also want to talk some about the economic growth and GDP components, what makes up GDP, and how is that looking for 2024. Part of that is going to be looking at consumer finances and how people also feel about the economy overall. And then also we'll wrap up with the consumer confidence based on political affiliation, which is a very interesting slide. It won't be overly surprising, but it's pretty fascinating. We're in an election year, so we wanted to make sure we touch on that. And we will take questions at the end. But let's jump forward and talk about 2023 and how the market did. All right, so this slide here is talking about the equity markets and the stock indexes. Here are some of the main indexes that we track throughout the year. Dow Jones, okay, very familiar. A lot of times that's what the news media quotes when they say, hey, the market went up 100 points today or it dropped 150. That typically they're referring to is the Dow. The S&P 500, NASDAQ. When we get into some of the more the indexes that focus on growth versus value, and then small mid-cap stocks. We'll go down this here, not over all of them, but we'll touch on some of the key ones. So in the year-to-date column there, you can see it's going to be the same as the 2023 column because that wraps up the full calendar year. But the Dow in 2023 was up 16%. All right, the S&P 500, we are now back into bull market territory, coming off of a 2022 where we saw a bear market, which is a 20% drop. We saw a nice recovery in the market last year, S&P up 26%. Just for reference, in 2022, S&P was down around 18. So rebounded up 26% in 2023. Back to the Dow real quick. The Dow was down around 7% in 2022. Rebounded up 16 in 2023. And NASDAQ, which is going to be more growth-oriented stock, tech stocks, those types of things. The NASDAQ 100 had a really nice year in 2023 at 55%. S&P 500 growth versus value. Okay, so when we talk about growth stocks tend to be like those tech stocks we were just talking about. Tech stocks, stocks that tend to reinvest back into the company, looking for more growth, as opposed to value stocks, which tend to have more cash on hand, usually have better balance sheets, and tend to pay dividends. Okay, so you think of utilities, energy stocks, those types of things would be the value. And in 2023, growth outperformed value. You can see 30% to 22% on the S&P 500 growth versus value. That is basically the opposite. It was even more dramatic actually in 2022, where value outperformed growth. So we're going to walk through some asset class returns here in a second and show how important it is to have that diversification, because if you're just betting on one type of stock or asset class to outperform, you have that additional risk. If we jump down to the Russell 2000, and so a little bit more than halfway down, we're talking more mid and small size stocks, up 16%, almost 17% in 2023. The Russell is down around 20% in 2022. So again, we're seeing that natural recovery come back off of a tough year in the market. International stocks would be if you look at the one right below the Russell 2000, the MSCI EAFE or EAFE, EAFE, Europe, Australasia, and Far East. That's kind of the broad-based international index that we track, up 18% last year. That's coming off of a down 14 the year before, so you can kind of catch a theme here when I want to talk about the recovery of stocks. Last year, the only one that was negative, we're looking at the very bottom one there, the S&P. That's a commodities index. We're going to run through a commodities slide here in a little bit, but just to recap this slide, you can see a lot of positive returns, and some of them pretty solidly positive. So we're pleased with that when it happens, and it's also, again, a pretty natural occurrence once you come off of a down year like we saw in 2022. Okay. This slide here is one of our favorites. We've left it off the last few webinars, but I wanted to bring it back because I think it does a really good job of describing every year you're going to have some type of volatility in the market. Okay. Now, when you look at up the title there, despite the average drop per year, there's always a drop from the peak. The average intra-year drop going back to 1980 is around 14%, 14.2%. So on average, we've seen a correction. A correction is a 10% pullback in the market. So over those last 44 years, on average, we see that correction. But in 33 of those 44 years, so 75% of the time, or 3 out of every 4 years, the stock market ends the year with a positive return. And you can see in 2023 on the right-hand side there that last year we ended up 24% up. That's the price return on the S&P 500. When you throw the dividends on top of it, that's what gets us to 26. But the price return up 24% last year. And you can see below that there was a time last year where we saw a 10% drop. There was a correction in 2023. It's kind of hard to remember or think about it because it was such a good year in the market. But last late winter, early spring, we saw the banking issues going on. If you remember Silicon Valley Bank going under, we saw multiple large bank failures in 2023. During that time period, the market was volatile and pulled back. And so we saw our correction happen. And despite that, we still saw an end of year return of 24% on the price return on the S&P 500. And you can go back here and look at different years, even the COVID year. So if you go back to the 2020 time period, the economy shuts down, market shuts down, basically it drops 34% in 1 month. The stock market at the end of that year, the S&P 500 was up 16%. Again, so this is something that's natural and that occurs every year. There's always going to be volatility in the stock market, but staying in the market, 75% of the time, we're going to have a positive year. That's what's shown historically. All right. When we look at this screen here, this slide, we reference this a little bit differently, but very much the same in our last quarterly webinar when we looked at the stock market in 2023, especially the first 9 or 10 months of the year. A lot of the returns we saw in the S&P 500 were actually driven by 7-10 stocks. Okay, we talked about the Magnificent Seven the last time we were doing a webinar. That's going to be Apple, Microsoft, Amazon, Nvidia, Google, Meta, Tesla. Those 7 very tech-driven type stocks really drove the market last year. And when you add on the next 3 largest stocks, Berkshire Hathaway, Broadcom, and JP Morgan, the top 10 stocks in 2023, on the left-hand side there, you can see they did 62% return. Those 10 combined, that was their return in 2023. And in the box at the top there, you can see top 10, the share of the return on the S&P 500 in 2023. Those 10 stocks contributed 86% of the return in 2023. And so that's something that's it actually was worse. It was almost 100% of the return most of the way through the year. So we did see the breadth of returns get spread out more as the year ended, which was nice. In November, December in particular, we started to see the stock market overall pick up and not just be so concentrated. But that's what happened last year. That's what happened in 2023 was those 10 stocks and the 7 that I mentioned before in particular what really drove the market. The remaining stocks added 14% to the overall return on the S&P 500. And so that's something to keep in mind. The PE ratio in the box in the upper left-hand corner, what that means, so price to earnings ratio, basically how much do you have to spend per dollar of earnings? Or another way to say it is how expensive is the stock, right? So those top 10 stocks have a forward PE ratio or how expensive they are per earning, dollar of earnings, 26, almost basically 27. If you look at the remaining stocks in the S&P 500, they're about 17. So when myself and Drew and our investment committee get together and look through, hey, what do we think is going to look at the data, look through the returns going forward and what we expect, how expensive our stocks, are we getting, do we want to get in when they're high, when they're low, or they're on sale? Those are types of things, and that's a data point that we're tracking often is, hey, what's the PE ratio on individual stocks versus the S&P 500. On the right-hand side, in the upper right-hand corner, how much of the 500 stock index is made up of those top 10 stocks, basically how their market capitalization, the size of those stocks make up, 10 stocks make up basically a third of the S&P 500. That's how large they've grown. You can see going back to 1996, this is definitely the highest that we've seen. Oh, I apologize. I think I accidentally muted myself. So I don't know where I left off there before I muted myself, but the upper right-hand corner was referencing the size of the top 10 stocks in the S&P 500. 10 stocks make up a third of the 500 stock index. That's a big chunk. So they really moved the market, and we saw that happen last year. The bottom right-hand corner, looking at the earnings that are kicked off from those 10 stocks, if their earnings at 23% don't match the size that they are. So that again speaks to how expensive they become, and again why it's important to diversify into other areas of the market. Hopefully, find better deals that, or at least something that's not quite as expensive that can give us some upside in addition to participating in the S&P 500 with those stocks. Asset class returns. On the left-hand side, you see the bar chart, and every year you're going to see different returns based on different parts of the economy and different parts of the stock market. The technology, consumer services, consumer discretion. So think of Apple, Google, and Amazon. Those three on the far left-hand side, you can see the returns that they posted, those different parts of the stock market, those asset classes and those sectors. We did have a couple that underperformed last year, right? And actually were negative and posted negative returns when you look at energy, oil prices pulling back last year, and then utilities. Okay, so utility stocks, think of it this way, with the interest rates going up the way they have the last few years. People, when they were at 0 or 0.5% on interest rates, they'd go to find some type of dividends. They would typically use utilities. Utilities would pay 4 or 5% in dividends, and that's one way that folks would take on some risk, some stock market risk that maybe they wouldn't otherwise if interest rates are paying more. So now at the bank, we can get 5% on a CD or a money market, those types of things. Folks got out of utilities at that point, okay, to go back into safer stocks so they didn't have to take on the stock market risk. All right, so that's the asset class returns over there. On the right-hand side, we have our style box. Style box, we've already referenced this quite a bit, is down on the right-hand side, you have growth stocks under the G, and you have a blend of growth and value in the middle there, value on the left-hand side, and then on the vertical axis, large cap, mid cap, and small cap. And so the winner last year, as I've talked about already, was the large cap growth. Those tech stocks that really drove the market last year, and growth in general, if you look at that compared to value, outperformed last year. Love this chart. Love this chart when we look at our asset class quilt. Okay, the different colors, the different the styles that you see year over year, going back to 2009 through this year. Again, this is really speaking to that diversification piece, where one year, take a 2022, for example, tough year in the market. What was the winner? Commodities, right? We saw a lot of inflation happening in 2022. Prices were going up, energy in particular, and food prices were going up. So commodity index was up 16% in 2022. Okay, if you said, all right, at the end of every year, I'm just going to invest in what did best last year, that probably wouldn't work out, because if you see in 2023, commodities were down and were the worst performer at -8%. That compared to even the one right above it, the second worst performer, which was the second best performer the year before, cash doing about 5% last year. It's pretty nice to see getting that kind of returns on cash, but compared to what actually happened in the market and other asset classes on here, it was the second from the bottom, while it was the second from the top the year before. So you can see year over year, the market is changing constantly. And then you can see kind of in the middle, the white box with the line connecting itself. If you had a well-balanced 60-40 asset allocation portfolio, how that's going to kind of pop around in the middle, right? Where that's going to take risk off the table. You're diversified. You're not taking on just one asset class or two. And over time, you're going to see different types of different parts of the market perform well one year, underperform the next year, and so on and so forth. This is why when we're, again, in our investment committee meetings, looking through not just, hey, what's the market doing, but also taking a deep dive to say, all right, well, REITs this year versus high yield bonds versus small cap stocks. How do we see that the different asset classes performing over the next 3, 6, 9, 12 months? And how are we allocated to that part of the market? So diversification is key, and that's I really like this quilt here because I think it does a good job of representing that. All right. Reference PE ratios before. Don't want to get in too much into that and be overly technical. On the left-hand side, that references the PE ratios of those growth versus value stocks. Again, think of the growth stocks being more the Apple, Google, Netflix, Amazon, those types of guys, more of the growth type stocks versus value would be, JP Morgan, Exxon Energy, those types of stocks that tend to pay more dividends, maybe not as volatile. And when you look at the comparison between the two, currently the growth stocks are a little bit more expensive when you think of their price to earnings ratio, so how much you have to pay for earnings versus value. Now, something that's interesting about that is what plays a role in what we see in terms of, hey, future returns, not just the current price of those stocks and how expensive or cheap they are, but when we look at how have those different stocks, the growth versus value, performed based on how interest rates are. So if you look on the right side, the bar chart, you can see over time what the returns have been on growth stocks versus value stocks when the 10-year treasury, which is a very commonly used interest rate that we look at, and how those stocks have performed in those different arenas. So if you look right dead smack in the middle, if the 10-year treasury is hanging out around 3 to 4%, which it currently is, right around 4, and the thought is that interest rates might fall or pull back some this year. If it stays in the 3 to 4% range, that's happened 59 times, going back to 1979 when you look at per month. Okay, so 59 months, those returns between growth and value have pretty much been the same. So that's kind of the sweet spot where one side versus the other historically hasn't really outperformed. That's one thing that we've been doing in our portfolios and our rebalancing and model changes recently is kind of equalizing our growth stocks versus our value stocks, because we anticipate the interest rates on the 10-year treasuries to hang out around that, the 3 to 4% range. As you go to the left and the interest rates drop even further, historically, that's much better growth type stocks. Okay, so as interest rates are lower, that the market verbiage is that's a risk on measure where to get returns, people, again, if they're not getting any interest at 0 to 2% or 2 to 3%, they may take on more risk and go into those growth type stocks. Not to mention the growth stocks tend to borrow more, right? They operate a little bit more lean. So when interest rates are lower, they get better leverage. If you go to the right, when interest rates are higher, the value stocks tend to do better. Okay, they typically have the better balance sheets. They don't borrow quite as much, so the higher interest rates don't impact them quite as much. But again, in conclusion on this slide, we believe interest rates should hang out in that 3 to 4% range, and that's why we have us more of an equal between growth and value in 2024. All right, I'm going to wrap up here on commodity returns, and then I'll pass it off to Drew. Commodity returns, why it's important that we've been watching these pretty closely the last couple of years is they play a big factor in inflation, and Drew's going to talk about inflation. But you can see at the end of 2022 versus the end of 2023 where oil was. So we did see oil pull back. Okay, oil did spike, throughout the year, but it ended lower at the end of 2023 than it did at the end of 2022. Gas prices pretty much the same. Natural gas dropped quite a bit. Gold, silver, copper, those precious metals. Okay, those prices for the most part did go up last year, and that's something that I know we've heard from clients over the last few years with inflation going up is, hey, do we want to get more into precious metals? And precious metals, historically, you can look at it as a hedge against inflation, but really it's more of a hedge against the dollar. And the US dollar, while we were going through the high inflation the last few years, actually remained pretty strong. So gold, silver, copper, they didn't really take off the way you might have thought because the dollar remained strong because everywhere else was also going through the similar inflation that we were. So the dollar was still preferable to most folks. Corn, food prices, those types of things, about the same, dropped a little bit, and the commodity index overall we saw drop in 2023, which helped out the inflation numbers. Drew again is going to talk about inflation, but there's the core inflation versus inflation that adds food prices, energy, that type of stuff. And when those pull back, the overall number starts to come down as well in terms of the rate of inflation. So that has been a positive. We'll see how 2024 goes. I'm going to pass it on to Drew here in a second. Let me get to the next slide. And I'll let him pick up with fixed income returns and key interest rates. So Drew, I will let you take it from here.
All right. Thank you very much, Evan. When you're chief investment officer, you get to talk about the fun and exciting things, the big 26% return in the stock market. But when you're director of financial planning, you get to talk about the things like inflation and fixed income and key interest rates. But while we all are often mesmerized by how the stock market is doing, for the vast majority of us, interest rates play a much larger role in our day-to-day life. So if we kind of look at the top portion of this page, we can see how different fixed income segments of the market returned. So if we see where my mouse is moving here year to date, the US aggregate, that's kind of the main index that tracks all investment grade or high quality bonds. So yeah, you may not actually be able to see my mouse. So in that year to date column, you can see that bonds were up about 5.5% last year. And if you look to the column just to the left of that, quarter to date, more than 100% of those returns came in just the last quarter of the year. So if you recall, I don't know if you were paying attention to the headlines of the news, but by close to the end of the third quarter, you're seeing things in the news like a 5% 10-year treasury bond or an 8% mortgage. We saw interest rates spark all the way up to the highest level that we've seen in decades. But by the end of the year, we saw large expectations that interest rates would move down throughout the course of 2024. Hopefully, that remains to be seen, and we'll definitely touch on that more here in a moment. But with those hopes, we saw a big rally in bonds to give us pretty good returns out of the bond portion of our portfolios last year. So 5.5 in kind of the diversified bond aggregate index. Corporate bonds were up 8.5%. Again, if you look to the column just to the left of that, you can see that pretty much all that return came in the fourth quarter as well. And then municipals. Municipals have actually kind of outperformed most segments of the bond market for a couple of years now. If you look at that 3-year cumulative return on the far right, you can see that the aggregate bond index is down about 9.5%, whereas munis are pretty much flat, slightly negative there. And then that bottom line, high yield, which just had a magnificent year, up over 13%. That was the only portion of the bond market that was actually positive heading into the fourth quarter. And they've done pretty well at about 6% per year the last 3 years. So, heading into 2023, we said we kind of expect bonds to behave more like bonds this year. And while there was a little more volatility than we had probably hoped for, given that bonds came out of the chute pretty good in 2023. By the end of the third quarter, they were, flat to negative. but they did end the year positive, and we're now finally getting some nice yield out of that portion of our portfolio. So bonds are, of course, they serve several purposes in our portfolios. We want them to pay us nice interest. We're finally getting paid on bonds with that nice interest. They serve as kind of the ballast of the portfolio, of a well-diversified portfolio. They're there to soften volatility, particularly in the stock market. And then also, if interest rates go down, then we might actually see some nice appreciation out of our bonds. So when you see negative 9% cumulatively over the last 3 years, that's because interest rates have been climbing. So let's look at these interest rates that we see in the bottom portion of the table here. We can start with just the first line. The 2-year Treasury ended the year right around 4.2, 4.25%. And if we look at a year prior, it actually trended down a little bit. It was about 4.4. But right there in the middle, you can see that that got to north of 5 just by the end of the third quarter. So we did see interest rates come down quite a bit in that fourth quarter, which is why we saw those nice returns. And then the second line there, the 10-year US Treasury, this affects so much in our lives. So this is really tied very closely to mortgage rates and a lot of other key interest rates that we pay, auto loans, things like that. Ended the year at 3.88%. If we look at where it ended 2022, 3.88%. So while it was a wild ride that got all the way up to 5%, I think for the first time in almost 30 years, we ended the year where we started, and now that we're getting a nice yield, we saw decent returns there. A few other things to point to on this slide. If we look at the second from the bottom, that 30-year mortgage rate, currently, at least at the end of the year, hovering around 6.83%. That's actually trended a little bit higher because that 10-year Treasury, which ended at 3.88%, is now close to about 4.15. So we've seen rates increase thus far in 2024. So mortgage rates have trended a little bit higher, but those got all the way up to 8% at one point last year. And so the housing market really just screeched to a halt at that point. Some of the worst year-over-year sales we've seen in a number of years there. So, and then last is that prime rate at 8.5%. Prime rate, that's the rate that banks and large institutions will loan out to other businesses that they find to be the most creditworthy. So these really creditworthy businesses like Apple and all these really strong companies, they're having to borrow at 8.5% right now. So as Evan spoke to earlier, when interest rates are higher, it's really tough for these growth companies who take their profits and reinvest it into the company or are using debt to grow. Because now they're borrowing at 8.5%, whereas if you look at the far right, at the end of 2020, they were only having to borrow at just over 3%. So almost triple the cost to borrow if you're a very credit-worthy business. So you can see there that interest rates really are meant to slow the economy, which is what the Fed has tried to do in an effort to bring down inflation. And I think right now there's a lot of speculation in terms of people have been forecasting a recession now for quite a while. Do we finally get that recession in 2024, or has the Fed pulled off what most people refer to as a soft landing, which means, maybe we see some softer economic growth, but we don't slide into recession? That all remains to be seen. But one thing we know now, 3 years removed from the end of 2020, on the far right of that bottom side, interest rates are higher, and we expect them to remain higher for much longer. So now, so much, whether it's interest rates or the stock market, depends on what the Federal Reserve is doing. There's a saying in the market, don't fight the Fed. 2022, it became clear that inflation had kind of gotten out of control. We knew the Fed was going to start raising interest rates quite aggressively. And so the stock market took a hit as a result. 2023, the expectation by the end of the year was that, the Fed would at least stop raising rates, if anything, and hopefully they would start cutting rates. So we saw the market recover as at least a main ingredient in that recovery. Now you can see, look at that vertical line there where the mouse is moving. Interest rates went up the most in the shortest period of time that we've seen in quite some time. The federal funds rate, which is the short-term interest rate that the Fed controls, it's the highest that we've seen since about 2001. You can see all the way back there coming out of the dot-com bubble bursting, when the Fed had to cut rates due to that recession. We're the highest we've been since then at about 5.38%. Now, of course, we just looked at how that equates to higher interest rates really across the whole spectrum of interest rates. But now that, and we'll see this on the next slide, now that inflation seems to be hopefully a little bit under control, or certainly has eased over the course of the last year, the Federal Reserve is expected to start cutting rates. So we can see in the blue, the dotted line there, the FOMC, that's the decision-making component of the Fed. They are expecting interest rates over the course of the next couple of years there to go down. They're expecting that by the end of 24, at the end of this year, that interest rates will be at about 4.6%. And then by 2025, decreasing further to about 3.6%. Now, of course, the Fed very rarely gets to follow their forecasts and make policy decisions based exactly how they expected them to be made. So the market says, yeah, we're not buying that necessarily, and we think the Fed's going to cut much quicker. You can see right there in the green, the market is expecting the Fed to be a full interest, or a full percent lower on their interest rate than the Fed themselves expect, at about 3.62%, and then decreasing further to about 3% by the end of 2025. So one of those two will obviously be right. If the market's right, then I think we can expect the stock market to cheer that news, and we can probably expect pretty strong returns. However, if the market's wrong, that may create a little bit of volatility. We're hearing a lot of the Fed chairs come out over the last couple of weeks, and they're kind of throwing some cold water on the rate cut expectations. Now, they're not saying they're not going to cut rates, but they're saying, hey, everybody, don't get too excited. We're not about to start cutting, at our next meeting or anything like that. So we'll see how it goes. And of course, the big driver of what the Fed does, they have a dual mandate. One is full employment. The other is inflation at 2%. Now, we've seen inflation at much higher than 2% for the last 2.5 or so years now. So that's coming down quite a bit. We'll see if that trend remains. And employment has been really strong the last, several years. And you can see there where the mouse is moving. They're expecting unemployment to tick up a little bit to about 4.1% this year from the current 3.8. And they're expecting economic growth to not be very strong this year at about 1.4%. And that kind of makes sense if you think about how high interest rates are. Again, their goal, which sounds a little backwards, but their goal is to actually slow economic activity, so that will hopefully bring down the rate of inflation. So if we go to the next slide, we'll see what inflation has done over the course of time. The blue bar is what's called headline CPI, or Consumer Price Index. That's the main figure that you'll hear in the news. You can see in November of 2023, inflation at 3.1%. I believe it was right at 3.0% for December. So call it about 3% on CPI. And then core CPI, which removes food and energy, which tend to be more volatile components of the CPI calculation, has been stubbornly high at about 4%. So that's double what the Fed shoots for at 2%. So while inflation has come down, and when I say inflation has come down, that does not mean prices have come down. Prices have not by any stretch of the imagination come down. The rate of which their prices are increasing has slowed. So you can see that peak there at just about 9%. I believe that was in June of 2020. June of 2022 there when it really peaked. You can see that blue line is meaningfully above the gray line of core inflation. But if you look where we are now on the far right-hand side, core inflation remains above headline inflation. And the big reason for that, as Evan showed us on that commodity slide, is that commodities, oil and gas, are down. So it's actually been pretty pleasant to go to the pump over the last, 3 to 6 months or so as we're finding reasonable prices there. However, everything else is remaining elevated, as I'm sure we all know when we go to the grocery store or buy pretty much anything else in life. So we still remain very locked in on what inflation is doing because that's going to be a big driver of what the Fed does and therefore how that trickles into everything else from there. So, it's going to be a very interesting 2024 on this front because last year, inflation's up 3%, but that's on top of the prior year 6%. So now we've kind of reset the baseline lower. So if it's only increasing by about 3% this year, then it would seem that the battle against inflation has come quite a long way, and they may have things under control. But if it reaccelerates quite a bit, then all bets are off. We'll see what the Fed does at that point. It's a lot harder to cut interest rates if inflation remains stubbornly high. So we're definitely keeping a close look on this, and we will see how it unfolds throughout 2024 because it's going to play into a lot of other things, particularly interest rates from the Fed. Now, this is a really interesting slide, at least if you're a nerd like we are in our investment committee. It's various segments of the bond market or of the fixed income market. You can see across the bottom there on the left-hand side, we've got U.S. Treasuries, municipals, investment-grade corporate bonds, mortgage-backed securities, other asset-backed securities, and so on, moving to the right there. So the big gray bars, that's the range of where rates have been in these various categories over the last 10 years. The purplish bar there in the middle is the 10-year median of where interest rates have been for these various sectors. And then the blue diamond is where they currently are. So you can see, except for, what is that one? Kind of the emerging markets debt there. Except for that, every other category in fixed income is in the top range of the 10-year range, or on the upper half of the 10-year range, as well as above the 10-year median. So what we look at when we see this in our investment committee is kind of what we've alluded to throughout the course of today's presentation, is that there's actually some appealing components of fixed income right now, most of them, as a matter of fact. So we finally can squeeze some juice out of the fixed income portion of our portfolios, meaning we don't have to take on as much risk. As Evan said, when interest rates are lower, that encourages investors to step out in the level of risk they're willing to take to get that higher return. Because if you can't get any safe returns due to high interest, then you're going to step out and take on more risk. So from our perspective, not only can we get nice yields on these segments of the fixed income market, we're actually able to get some nice appreciation if we see interest rates come down as well. So if that 10-year treasury, which is a little north of 4% right now, goes all the way to 3%, so we can see treasuries are yielding that 4.1%, they have what's called a duration of around 6. So without getting too bogged down into what duration is, that just means if interest rates move up or down by 1%, the price of that bond will move by 6, by what the duration is. So we're getting 4% just in a yield. If we see interest rates go down 1%, then we're going to get a 6% appreciation. So we have potential for double-digit returns in fixed income if we see rates go down on top of the nice yield that we're already getting. So the risk return is kind of in favor of fixed income right now, in that you don't need to take on too much excess risk to get the returns that we're hoping to get out of a well-diversified and well-balanced portfolio. So we're pretty pleased with where fixed income sits, and we can kind of expect decent returns out of fixed income, barring major increases in interest rates from here. Okay, so if we go to the final, or not the final slide, the next slide, we'll take a deep dive into GDP. We can see here on the chart, goes back to about 2001 through the end of last year. Trendline GDP growth has been about 2%. While we certainly would like to see higher than that, that's where we've been the last 20 plus years. And you can see now that we're finally kind of getting back to that trend line. I believe the expectation for fourth quarter GDP is around 2.5, somewhere in that range. So we're recovering from the COVID decline in economic activity, and we're kind of getting back to trend line there. On the right-hand side, you can see the components of GDP, and obviously there's a big portion, almost 70%, that comes from consumption. So America, we are a consumer-based economy. And so if the consumer is doing well, generally you'll see the economy doing well. And then, the other larger chunks are investment, excluding housing, and then government spending. Um, in our humble opinions, government spending is a little too high right now. We'd like to see that come down, but it has kept GDP a little bit elevated. But, the real big takeaway here is that consumption, or the consumer, is the main driver of GDP in this country. So when we're looking at economic data, we have we're always hyper focused on how the consumer is doing, which we'll look at here on the next slide. Okay. So there's a lot of good data on this slide. Some of it is pretty nuanced. You can see on the left-hand side there, the consumer balance sheet. Americans have about $171 trillion worth of assets and about 20 trillion worth of liabilities. So that's a pretty handsome looking balance sheet for the average, or not for the average consumer, but for consumers in America. However, that's highly skewed due to the concentration of wealth, kind of at the top end. So this is not what the average consumer looks like, but on the whole, it's a really nice balance sheet, actually. And it has the ability, because of the concentration at the high end, to kind of mask what may be going on for the everyday American or the working American, because we all know the average consumer does not have a balance sheet that looks quite so appealing. And so the average consumer is not quite doing as well as this may reflect. But if you look at kind of some of the underlying things, the chart in the top right-hand corner, household debt service ratio. So what percentage of disposable income is going to make debt payments? It's been a major increase from the low following COVID, but it's really kind of just back to that trend line we've seen coming out of the 2008 debacle. So nothing there is too alarming at this point. We'll see if that number keeps climbing or not, but right around 10% where we're at now is actually pretty healthy. You can see at the peak there in the fourth quarter of 2007, before the '08 great financial crisis, it got all the way up to 13%. So as of now, not much concern there, but we always keep our eye on that. And again, that can kind of be skewed by the folks who don't have any debt service, because they might be in better shape compared to the average person. But one thing we're really keeping an eye on in the bottom right-hand corner is delinquencies. So you can see in blue, that's auto loans, credit cards in the gray, and then student loans there in orange. There's not much of an issue with student loan delinquencies, because people haven't really had to make any payments on student loans until a few months ago when those restarted. But auto loans and credit cards, we've definitely seen an uptick in delinquency. So we're keeping a really close eye on that. And it's, I would say, slightly above the trend line coming out of the great financial crisis, but nothing too alarming yet. However, a lot of consumers are now having to turn to credit cards to kind of maintain their standard of living, and that's only sustainable for so long. So we're really keeping a close eye on this. Credit card debt is at an all-time high, over $1 trillion for Americans. And auto loans are obviously meaningfully higher than they were from an interest rate perspective. than they were just a handful of years ago. So we're keeping a close eye on this because, again, the ultra wealthy don't have to worry much about missing a credit card payment or missing any car payments. But the average everyday American certainly has those two components to deal with. So we're keeping a close eye on that, and we'll see how it goes. But as a whole, the consumer is in a good enough spot right now to keep things kind of chugging along. But it's kind of getting to a point where inflation is starting to take a toll on the average American. So we will see how things unfold from here. But as of right now, things have kind of just returned to where they were pre-COVID in a lot of these instances. Okay, so we've got a couple more slides for you today. We used this in one of our 2022 webinars. It was right when we were near that bottom. And the message here, this is the Consumer Sentiment Index. The message here is that that old Warren Buffett saying, when others are greedy, be fearful. When others are fearful, be greedy. So if we look at the far right of the graph there, June 2022, consumer sentiment hit its low point. One thing just to note on that, you can see it's actually lower than it ever got during 2008, and even lower than it got during the hyperinflationary periods of 1975 and 1980 there. So I think that kind of serves as a message that even if the economy itself is awful, like in 2008, nothing quite stings the everyday American quite like inflation does. So inflation, again, that's why we keep hitting on that point. It is crucial to how the consumer does. It's crucial to where sentiment stands, and it's crucial to where interest rates go with the Fed. So once we hit that bottom point there, again, that's when everyone's feeling the worst. The market's in a bear market at that point. However, that's when you want to buy, because when things look darkest, that's when there's the most upside. And since that point, the stock market's up over 17%. And that includes, the market even went lower from there. So that includes additional declines into October of 2022. And now we still are lower than the average of 85. So that certainly means there could be more upside for the market. We'll see how that goes from there. But if you look at, very interestingly, this little table here in the top left, in the 9 sentiment peaks, 12 months later, the S&P 500 is up 3.5%. During the 9 sentiment troughs, the market's up 24%. So again, we've climbed out of the deep holes that we were back in June of 2022. We've seen really strong markets since then. And this is just always goes to show that when things may feel like they couldn't get worse, that's normally when there's upside to be had and when superior returns can be made. So we'll see where things go from here. It's definitely improved. We're not back to the average yet. So I think a big driver of this, of course, as I mentioned a moment ago, is going to be, what does inflation do in 2024? If it continues to moderate, we might see that climb higher. If it sparks back up, or if we do go into a recession, that actually could go lower. So we always just like to keep tabs on how sentiment is out there. And when sentiment's bad, that's normally when we as investors want to buy. When it's good, returns are still positive and we don't not want to buy, but maybe we just expect that returns aren't as strong moving forward. Okay, and here's our final slide of today. Evan mentioned it earlier. It's a very interesting yet not overly surprising slide. We will have more information throughout the course of the year on how the market and the economy does during election years. Obviously, it's a contentious environment out there. So regardless of which, quote, team you're on, it's not surprising to see how this goes. So we can see when there's a Republican in office, that's our red line. When there's a Democrat in office, or actually, this is just how Republicans feel is the red line, how Democrats feel is the blue line, and then obviously in the middle there is the total between the two. So from 2000 to 2008, we had a Republican in Bush in office. And not surprisingly, Republicans always felt like the economy was doing far better than the Democrats did. And then we obviously experienced the '08 crash. President Obama gets elected. No one's feeling too good about the economy at that point, but then moving forward, you can see the blue line is on top. So Democrats feel as though the economy and everything is doing better. Then at the end of Obama's term, we switch over to Trump. You can see right there at that election there in 2017, what is that? Oh, Democrats about 45% feel things are doing well, less than 20% for Republicans. And then in less than a year, that completely flips when President Trump is in office. And then obviously we move into our COVID 2020 situation. We flip over to President Biden. And while no one feels the economy is doing too stellar right now, you certainly see that Democrats feel things are better than Republicans do. So the main takeaway from this particular slide is that if your guy or gal is in office, you probably feel that things are doing better than people who don't particularly like that person in office. But that does not mean that things are better or worse. The last 30 years, the market's done 10% a year, and obviously we've had 12 or we've had an 8 years of a Republican, 8 years of a Democrat, 4 years Republican, 4 years of a Democrat, and yet we're still getting 10% a year. So regardless of how you feel, we want to strip the emotion of how we feel about things politically from our investment decisions, because more or less it is irrelevant which party is in office in terms of how the economy and how the stock market's going to do. There's obviously exceptions, but we'll come with more data throughout the course of this year and bring you some other good election year data. But for now, that was kind of a recap of all things 2023. It was a really good year for the markets. We want to give kudos to all of you who remained patient throughout a tough 2022, remained invested, and you were certainly rewarded in 2023 with the recovery that we saw. So with that, we will open it up to questions. If there are any questions, do feel free to throw those in the chat box. And we'll give that a few minutes. And if there are no questions, we'll let you get on your way. We thank you so much for your time, and we know how valuable it is. So thank you very much for listening through with us today. We'll give it a few moments for the chat. We'll see if any questions come in. And again, thank you for attending today's webinar. And again, we do these quarterly, and we will definitely be doing some non-market and economy webinars this year. We plan on doing a Social Security webinar, amongst a few other things. So keep an eye out for those invitations, and we look forward to seeing you and meeting with you throughout this year. As of now, I don't see any questions coming into the chat box, so Ev, we'll give it another minute or two and see if anybody has any questions.
Thank you, Drew. And as he mentioned, we do these quarterly, but we're going to send out a calendar of the webinars we're putting on this year. As Drew mentioned, Social Security is going to be one of those ones that we want to make sure we do. We brought Randy Anderson joined us and is we're excited to have him. He's a phenomenal resource to us as a planner. He's also really good for Social Security. And I know we're going to do one on the investment committee itself. So we're going to kind of pull the curtain back and see and let you see kind of how we come up with our allocations and do our analysis and those types of things. So that'll be hopefully something that's interesting. We do have a question here in the chat. Some analysts are projecting massive defaults on mortgages. What are your thoughts? How would the market be impacted? Drew, you want to go, and I'll wrap up with my thoughts as well.
Yeah, so this is a really good question. And of course, we don't have the data handy to show today, but there's a few points that I'll hit on. One is even though we've seen mortgage rates just skyrocket the last couple of years, as we saw, or as I mentioned, they peaked near 8%. Now they're down closer to 7%. While that's a very alarming number, and I believe the percentage of income that it takes to um, maintain today's average home price and average mortgage is certainly at a multi-decade high, if not an all-time high. So it is very tough if you're getting a new mortgage. However, again, I don't have the data, and I'm gonna throw out a figure that may not be 100% accurate, but I think it's pretty close. I believe that it's well over 80% of existing mortgages, if not even higher. But just to kind of hedge myself a little bit, I'll say it's 80% of mortgages are still at interest rates of 4% or less. So even though interest rates have been really high the last couple of years, most folks do not actually have mortgages at those rates. So if we do see defaults, it's likely to be on those higher rate mortgages. And so it won't affect as big of a portion of mortgages as you'd maybe expect. So we'll see how that goes. Now, of course, if the economy goes into recession and people get laid off, it doesn't much matter how big or how high your mortgage rate is, because if you're not bringing in income, you can't pay your mortgage. So we'll see how that side of things unfolds. But mortgages themselves having high interest rates isn't actually as big of a concern yet, as it may seem, because most folks still are locked in at those really, really low rates. Now, I would say it's not specifically in this question, but I would say that the bigger concern in our eyes is the commercial real estate side of things. Commercial real estate is undoubtedly in a bear market. Prices of commercial real estate are down well over 20% in many instances. And the way they do loans is much different than the 30-year fixed mortgage. So most commercial real estate loans will have about a 5-year period where you have an interest rate, and then that interest rate resets. I believe by 2025, the vast majority of commercial real estate loans will reset, and they'll reset to these much higher interest rates. And that's also when we see vacancies in this, work from home era that we now live in. Vacancies are down for a lot of buildings. So, I think the more negative side of the economy right now is the commercial real estate side. Mortgages are hurting a lot of folks due to the high interest rates, but not nearly as many as it may seem, because most people are still locked in at those lower rates. So I know I just rambled on there for a while, but anything you'd like to add to that, Evan?
Yeah, no, I think that was great. The commercial real estate part is what I was gonna to jump on as well, is that's what's most concerning to us as we're looking at real estate in particular. It's gonna be more on the commercial side of things, simply because of the fact that those loans and interest rates are gonna be popping up on people here soon. The other part from a residential perspective that I'd throw in there is HELOCs, right? So those who took out some home equity lines of credit, those rates are also, tend to be floating and are higher. So that type of a loan when it comes to residential can be a little bit concerning, but for the most part, like Drew said, I think the residential side of things, what we're seeing is just things are kind of coming to a halt. And if you have a 3% mortgage, but prices haven't come down enough to where you want to move and potentially get a bigger house or something like that, those prices haven't come down to a point that it makes sense to take on a higher interest rate. So I think that's something that something's going to give. Either interest rates are going to start coming down, or prices, or both. And so what's something we're watching really closely. But again, I think that I'm with you. The commercial side is much more of a concern for us. But that's a great question. I think that's something that is on a lot of people's minds, is interest rates. When you think of interest rates, you think of mortgages and you think of real estate. It looks like that's the only question we had in the chat. And so that's it for us. This is recorded. We will post it to the website, but we'll also email it out to everybody. And soon we'll get out the webinar list of, hey, here's what we're going to do throughout the year. And if there's any feedback on how we could do things better, or if there's a topic you want us to present on as we speak with you throughout the year, please make sure you let us know. We love doing these, and we have some of the other wealth advisors that have some specialties that can jump in and help us out as well. So everybody enjoy their Thursday, and we will speak to you soon.
Thanks, everyone. Take care.
Thank you.